rum cake, everything is going to be a...
Oh, wow, that's going to be a good Monday. No Monday blues then. Well, just 15 days left for the year to end. And of course, through the course of the next 2.5 hours, we're going to get you a lot of opinion, not just on the day, but on how you can approach 2023 as well. Let's kickstart with one view coming in from Lawrence Belanco of CLSA, who says, while the Nifty has seen price action pull back to the 18,150 to 18,500 area, a test and a rebound off this level would reinforce the original breakout from the more than 10-month consolidation pattern, which still supports an initial upside target of 20,180. He says the key leadership sector for the Nifty remains the NSE Banks Index, which has recently broken out of the September to December consolidation pattern, which followed the break above downtrend resistance drawn off the 2020 highs.
Well, moving on to a view from, Bill Ackman. Bill Ackman, of course, is a famous investor at Pershing Square, who says that the Federal Reserve's 2% inflation target is no longer credible. He says deglobalization, the transition to alternative energy, the need to pay workers more, lower risk, shorter supply chains are all inflationary. He says the Fed cannot change its target now, but will likely do so in the future.
Right. It's also important to get you some money market views, considering the way the rupee has been moving lately. For now, Parul Mittal of Standard Chartered says the dollar INR is facing upward pressure despite weak dollar and lower oil prices. On strong importer demand, she says dollar has held on to losses despite more hawkish FOMC decision. She expects the dollar INR pair to trade in a range of 81.50 to 83 for the next week.
Well, on bonds, Parul Mittal says that domestic yields saw some upward pressure on more hawkish than expected MPC decision, though retraced on cooler than expected India and US CPI. She says the FOMC hike rates is expected by 50 basis points with a hawkish guidance and raised the terminal rate range to 5 to 5.25%. She expects the 10-year benchmark bond yield to trade in a range of 7.15 to 7.3 next week amid muted moves in global rates post-FOMC decision.
Well, we have a lot of stock-specific action as well that we're tracking, and we'll get to that in just a bit. We're looking at Poonawalla FinCorp, Glenmark Pharma, JB Chemicals, Sapphire Foods, VRL Logistics, Shriram Properties, Torrent Pharma, Thermax, and Hinduja Global Solutions. All those stocks on the back of positive news flow, while IRCTC, the OFS has been announced, so that one will open up in the red.
All right, well, those are all the stocks that we're going to focus on. But the big headline overnight, the US Fed has gone ahead and raised rates and also has indicated that they see no immediate end to rate hikes. So let's listen in to what Fed Chairman Jerome Powell had to say on the fight against inflation. We'll come back.
As we've gone through the course of this year, as we lifted off and got into the course of the year and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. There's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time. Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way.
All right, let's get some opinion in, and this is interesting opinion as always. Jahangir Aziz is head of emerging markets, economics research and commodities at JP Morgan. And Dean Kim is head of global research product at William O'Neill. Great to have both of you here. Thanks very much. Jahangir, what did you make of the decision last night? And more importantly, I mean, the market reaction to it. the fact that the dollar was actually down on the day when the Fed was nothing but as hawkish as it could be in the current context?
Look, I think the dollar has been down, and market has essentially been saying that, look, regardless of what the Fed says, when the recession hits, the Fed will be forced to cut, right? And you heard what Chairman Powell said. I mean, that they are not even thinking about rate cuts in 2023 because they're nowhere close to even pausing or even deciding how long the pause will be. So my sense is that as this reality sort of seeps into the market in the next few months or maybe even sooner, I think you will see the 10-year again test 4% or even higher, and dollar strength will be back. I think this is simply the market reacting to the 2 inflation print and saying, look, inflation is over, and even if there is a recession, the Fed will have to cut when the recession hits them. The Fed cannot pause till it goes and finds out that the inflation is headed towards that sustained 2% level.
Okay. Well, Dean Kim is also with us. Dean, is there more pain for global markets as the Fed decides to keep rates higher for longer?
Well, I mean, it's been very interesting couple of days. We're starting to see, inflation numbers coming in a little bit cooler. So yesterday, November CPI number came in cooler, and so the market reacted positively. Of course, today, the Fed came out with a higher dot plot, which will peak at 5.1%. So I suspect, there's going to be some volatility in the near future. But what's interesting from my point of view is that if you look at the short-term 2-year bond yield, it is now declining below the Fed funds target rate. Today it was around 4.2% versus a peak of 4.7 in November, and certainly much lower than the Fed peak forward curve rate at 5.1. So what the bond market is telling us is that the Fed continues to be behind the curve. And all throughout this year, the 2-year bond yield was much higher than Fed policy rate, and now it is reversing and going lower. So this means that the Fed may be overshooting, and we may see faster pivoting than what the dot plot is suggesting. But I think in the meantime, we're going to see some volatility. The market is finding it very difficult to reclaim the 200-day moving average, like on the S&P and the NASDAQ. So until the market kind of breaks above the 200-day moving average, I think we're in the camp of volatility.
All right. Hi, Dean. Good morning. Dean, what about India? I recall, when we chatted the last time, you said that Indian markets are looking a little bit toppish, and maybe taking some money off the table would not be such a bad thing. What's your view now?
Yeah, I mean, it continues to be very constructive. I mean, it's the best performing market in emerging market, let alone globally. And what we're seeing is the sensex index finding nice support at around 21-day moving average. It came off the highs, but on low volume, which we think is very constructive. So the next support is 21-day moving average, which is only 1% away. And if you do see a bounce there, I would say, the market would continue to be in confirmed uptrend. Right now, we're seeing a lot of stocks breaking out early stage basis. So nothing's really changed from last time I came on and spoke. Indian market continues to be, very desirable globally, actually.
Jahangir, just to go back to that point that you made, right? That the market will reprice higher. I mean, dollar and yields, etc. Is it possible that I think it's widely acknowledged, and you would agree, that Fed was behind the curve in terms of raising rates, and then they had to do all of this very, very quickly. In a way, the market is now saying that they are behind the curve and pausing, or not cutting, but pausing. I mean, they're going too far. Is it possible?
Look, anything is possible. But so far, what is the evidence we have on the ground? If you look at the part of CPI basket that Powell keeps going back to, which is the non-rental services, which is about 55% of US basket, that basket hasn't really shown any signs of cooling off, right? I think the pace has come down, but it's still very strong, as Powell himself mentioned. And that's the part of the CPI basket that is directly linked to the labor market, which again has showed no real signs of going anywhere close to where the Fed would find it comfortable. So my sense is that, look, anything is possible. Economists do almost all the time do not, underappreciate the pace at which things change. That is not uncommon. I'm sure that this time around, when we look back at this episode, a few years down the road, we'll say, yeah, this pace was underappreciated, both the up and the down. But right now, given the data flow that you have, you had a non-farm payroll that beat expectations 2 straight months. You had wage growth above expectations, and I think that the fact that that CPI inflation is coming down is fine and it is welcome. But the point still remains: the part of CPI inflation, the 55% of wage, which is the non-rental part, that still hasn't showing any signs of cracking.
Yeah. The bigger problem, Jahangir, for equities is always growth, right? How much will all of this action hurt growth? So after yesterday and what we've heard, and if they stay the course, does it kind of confirm that, the growth will come off, even at a sharper pace in the US, and that is by far the largest economy with effects around the world?
I think if the pace of growth comes up at a sharper pace, I think you'll get relief from the Fed. So, but I don't think that the pace of growth is coming off at a faster pace. I think we are still looking at a recession somewhere down in 2023, and that goes into 24, but it's going to be a shallow recession. But I think what is interesting is not so much that the US economy is going to slow in the second half of the year, but that is also going to be the time, given the faster reopening in China, that the Chinese growth is going to pick up at that point in time. So I think what has happened is that global growth is not going to lose both its engines at the same time. Okay. And I think that's the more important point about emerging market asset pricing, that when the Fed is going to when the US is going to lose steam, that's exactly when the Chinese economy is going to pick up, which is what we think is going to happen in the second half of the year after all of this reopening volatility goes by. And so I think from a growth perspective, I think that the global economy, China and US together, is going to provide some sort of support and comfort to emerging markets. Okay. Now, it depends. Are you an emerging market tied more to the US cycle, or are you an emerging market tied more to the China cycle?
Okay. Well, it's always good, right? Whatever benefits emerging markets is good for our viewers and investors back home. But since we're talking about India and emerging markets, Jahangir, just leave us with your view on what the RBI will do from here on. Because do you think that the November CPI data is perhaps a game changer for the RBI, given that this decline in inflation could give some breathing space to the MPC in its fight against inflation?
I think the RBI has more or less shown its hand, just like every other Asian emerging market country has shown its hands, that they are, in fact, some of the emerging market Asian economies like Indonesia, in fact, stepped down even before the Fed did. So I'm sure that the RBI will follow suit and will step down. And, this is also going to be the case for other emerging market countries, especially in the first quarter of 23, where I think you'll see disinflation across emerging market taking place. But if you look at what are the macro vulnerabilities that India face, India still has a 3.5 to 4% current account. India has a fiscal deficit of 10.5 to 11%. Inflation, even if it comes down, it's going to be around 6%. And the 10-year rate is at 7? That is not compensation for the macro risk that India or countries like India among emerging market countries, that is not a compensation for that risk.
Okay, we'll leave it at that. Dean and Jahangir, thanks a lot for giving us your quick take on what to expect going ahead from both the Fed and the RBI and the implications it would have on our own markets. Let's slip into a quick break. Our entire team will be with us to tell us what to expect in terms of individual stocks as we come back after a break. Welcome back to Bazaar Morning Call. Well, for now, the SGX Nifty is down about 70 odd points. It looks like it's going to be a start on the back foot for the bulls. A lot of Asian markets are also under pressure this morning. Hong Kong is down about, I think, 1.5%, 2% now gone on Hong Kong market, and a couple of others in the red. But our research team is here to give us a list of top 10 stocks as we begin trade this morning. Poonawalla FinCorp is the one on our radar, and Nimesh can tell you I told you first. Nimesh, over to you.
Thanks, Sonia. So today, there is an official announcement last evening that Poonawalla Finance has agreed to sell the housing finance business to TPG for 3,900 crores. Now, that means they're selling the stake at price to book of close to 3.4x, which is quite decent, given the valuations for the other housing finance companies. So I'll go with the green for this. But interestingly, the company has gone ahead and said they're going to focus on technology-led growth, and they're targeting an AUM growth of 35 to 40% over the next 3 years. And they're looking at investments in the technology and analytics. Now, what I understand, going forward, they might also, do an acquisition in the fintech space on a big deal. So that's something to watch out for going forward. But today, I'll go with the green for Poonawalla, largely because they've sold the housing finance business at almost 3.5 times book to TPG for 3,900 crores.
All right, Nimesh, let's rebrand your segment, D Street Chatter in the afternoon. And in the morning, when you're on, let's call it, as we told you. Because I think, the strike rate is absolutely astounding. And congratulations. So not just, this one, but a few others that you put out on the chatter, all getting confirmed within a day or maybe the next couple of days.
Going with, Nimesh's personality, he can rebrand it as Maine Bola Tha.
All right, so don't miss that, the segment D Street Chatter, which, of course, which comes on at 3:05, 3:10 every day in the afternoon. Nimesh, thanks for that. IRCTC is the next one, where there is a OFS. Mangalam is here with more. Mangalam, hi, morning.
Good morning. So a lot of people on the street were anticipating this to be announced soon. And yesterday it was announced. The IRCTC government announcing their offer for sale has formally happened. It's a 2.5% stake that is the base offer at a floor price of 680 rupees, which is at a 7.5% discount to yesterday's close. So to that extent, the opening will be lower in that stock. In case of additional, subscription, they also have an option to sell an additional 2.5%. So the total offer would be close to around 5% The government, of course, owns around 67.4% stake in the company. So if it is oversubscribed, so to that extent, their stake will come down too. Because the floor price has a big discount, expect the stock to open in the red today.
Okay, all right, Mangalam, thanks a lot for that. Well, let's hop across to Sonal. She's filling in for the pharma space. There's a deal announced out there as well. Sonal?
Yes, good morning, Nigel. Well, it is between Glenmark Pharma and JB Chemicals, where Glenmark Pharma has gone ahead and they've divested that cardiac portfolio, goes by the name Roselle in India and Nepal, and they have sold it to JB Chemicals for a consideration of 313 crore rupees. Now, the franchisee sales for this cardiac brand in the first half of FY23 was at 29 crore rupees, and JB Chemicals will be funding this acquisition via long-term debt and internal accruals as well. Now, remember, JB Chemicals had a debt of 150 crore rupees in its books as on first half of FY23. The total market size of this portfolio, that is the Roselle franchisee in India, is 2,440 crore rupees. So that's the opportunity size that we are talking about. Credit Suisse has written on JB Chemicals, where they say that this portfolio that has been sold to them has an EBITDA margin of 60%. However, this acquisition is neutral or maybe mildly positive in terms of EPS accretion for the company. India now constitutes 2/3 of JB Chem's portfolio, and this acquisition has been made at 9 times FY24 EBITDA of this Roselle portfolio itself. So expect these two stocks to be in focus on the back of this acquisition.
Okay, thanks a lot for that. So we'll keep an eye out on both JB Chemicals and Glenmark Pharma, but Sapphire Foods is also in focus. Nimesh is here to tell us the latest on that. Nimesh.
Hi, Sonia. So a large block, over 11% equity is going to change hands today. 3 marquee investors, which includes Sapphire Food Mauritius, they are going to sell close to 40 lakh shares. Goldman Sachs AMC is going to sell close to 32 lakh shares. And QSR, which is a private equity, that's going to sell close to 1.5 lakh shares. Now, the floor price is 1330, but I believe the deal will happen in a block window, so 1% discount to yesterday's closing price. For all the investors except for QSR, there is going to be a 90-day lockup. But given that there is a strong demand and the block expected to be in the block window, expect the stock to be in the green today.
All right, thanks a lot for that, Nimesh. And Nimesh also alerted us about VRL Logistics. Vivek, promoter sold out there.
Well, absolutely right. He had indicated it earlier, and it's been confirmed. So yesterday during the session, we saw a very large block changing hands as far as VRL Logistics was concerned. So one of the promoters, Vijay Sankeshwar, yesterday sold almost 5.42% stake in the company, and this particular deal was done at 570 rupees a share. Now, some good buyers coming in terms of mutual funds. ICICI Prudential Mutual Fund, Max Life Insurance bought almost 7 lakh shares, and also Quant Mutual Fund picked up stake in yesterday's block deal. Now, just to reiterate, Vijay Sankareshwar held almost 33.72% stake at the end of September quarter, and the promoter as well as the promoter group entities held almost 69.59% stake, so a reduction of a little over 5% stake as far as the promoter group entities are concerned.
Okay, thanks a lot for that. So that is on VRL Logistics, 5.42% stake sold by the promoter. But there are some more stocks that are in the news. Vahishta is here to give us the lowdown. Vahishta, over to you.
Hi, thanks for that, Sonia. Let me start with Shriram Properties, which has acquired Golden Era, which is a plotted development project with an aggregate saleable area of 10 lakh square feet, which comes in northern Bangalore through its wholly owned subsidiary SPL Housing Projects. Now, Golden Era is a plotted development project of the Golden Gates Group, which was a stressed asset with lending entities and part of the IIFL Group. 125 crores has been committed towards the acquisition and development of this project. Moving on to Torrent Pharma, which has entered into a co-marketing partnership for its anti-diabetes drug and its fixed-dose combinations in India. This comes with the background of India being the second largest diabetes patient base in the world with an estimated 74 million adults. Thermax had earlier received demand notices for the excise department for approximately 1,318 crores, for which Thermax had filed an appeal against the same before the Customs, Excise and Service Tax Appellate Tribunal in Mumbai, and the tribunal has now allowed the appeal in favor of Thermax on the 13th of December. So some positive news here, though there is no financial impact on the company due to the said order. And the last stock is Hinduja Global Solutions, which will be having a board meeting on the 19th of December to consider a proposal for buyback of shares. And the cash and bank balance on the books of the company is at approximately 2,300 crores. Back to you.
All right. So that's Vaishya, thanks very much for that. Let's quickly recap things for you, right? So our top stocks with positive news flow are Poonawalla FinCorp, Glenmark Pharma, JB Chemicals, Sapphire Foods, VRL Logistics, Shriram Properties, Torrent Pharma, Thermax and Hinduja Global Solutions, while somewhat reddish could be IRCTC on the back of that OFS news flow. All right, that's a list of stocks to watch. Well, Manisha is now joining in for a roundup of what's making headlines in the commodity space. Manisha, hi, good morning.
Morning, Prashant. Thank you for that. I'll start with the crude oil prices, where we have seen a 2% of a jump up yet again for a third straight day. Positive trades coming in for the crude oil prices. And we have moved quite far away from that one-year low that we hit on December 9th itself at $75 a barrel. So holding above 82 on the screens. The U.S. crude inventories jumped the highest since March 2021, but even then the crude price trading firm. That is because of the supply disruptions due to Canada's Keystone Pipeline have continued and may continue for the next couple of weeks as well. And then there are statements from OPEC and IEA which have offered bullish demand outlook for 2023, especially with the Chinese markets reopening, and that continues to add premium to prices. But no such luck for the metal space today, where you have seen some decline come in. Some profit taking is on the screen right now. The U.S. Fed has delivered expected 50 basis point rate hike, but the terminal rates will be higher, and no rate cuts before 2024 is what has led to profit taking. And the traders now clearly are awaiting for the ECB, Bank of England, and the Swiss monetary policy decisions this week. The next couple of sessions, that is, are expected to be choppy alike.
Okay, all right. Thanks a lot for that, Manisha. Well, we'll slip into a short break. Up next, Gurmeet Chadha, Managing Partner and CIO at Complete Circle, will join in. We'll discuss some fundamental stock analysis. Later on, we'll connect with Nirmal Jain, founder and chairman at IIFL Finance, as the company obtained co-lending commitments for nearly $2 billion. Stay with us. Welcome back to Bazaar Morning Call. Hope you're having a good morning. For starters, the SGX Nifty suggesting a bit of a pullback, 60 points odd. Well, Gurmeet Chadda, Managing Partner and CIO at Complete Circle, joins us on the show. Hi, Gurmeet. Good morning. Well, the big deal that came overnight was Poonawalla, the housing finance arm has been sold, and they're getting a valuation of roughly around 3.5 times odd. My question to you is, how do you, look at the stock from here on? And more importantly, does this, re-rate the other housing finance companies, or should we be looking at this deal in isolation?
So I think pretty positive for Poonawalla. Also, if you see, Nigel, their operating metrics, if you see last quarter, the disbursements are up like 30% plus. In fact, quarter on quarter, the AUM growth was up. I think that their entire strategy of first writing off aggressive write-offs of the legacy book they have, and the recovery rate has been very good, has also managed to pull down the credit cost by, so it went down to almost 0.8%, which was very positive. Has run up, reasonably well compared to the other NBFCs. They continue to expand both physical presence as well as digitally, and I think continue to do well even on the new products which they are launching. So. Pretty constructive on it. I think there'll be. I don't think so. I agree with you. Should be looked at more in isolation than which are again the quality of the book you have rather than just broad basing it for the entire industry. Also, I think that the work they are doing on the deposit base is something which we need to track, because what will happen is the cost of funds will inch up much sharply for NBFCs vis-a-vis banks. So players like Poonawalla, even something like Bajaj Finance, which has a very retail deposit base, I think that will be a big differentiating factor as we head into the next year.
Okay, Gurmeet, hi, good morning. Always great seeing you. Another stock in focus this morning is IRCTC on the back of the OFS of 2.5% that the government has announced. What do you do with a stock like this?
So this is one stock which, as it's we say that in cricket parlance that a lot of potential, but somehow not taking off the way it should. If you see last quarter, they booked almost 107, 108 million tickets. This is like 11 crore tickets booked in a quarter, makes it probably one of the most heavily transacted website in Asia Pacific, if the numbers are correct. Convenience fees almost 200 crores. So I think that flip-flop on convenience fees has created some confusion. So I think it probably will take some more time. Also, the railway need and their catering business, I think, will recover. The need expansion now is in place. So I think the daily bottles will go up from almost 1.5 to 1.7 million now. And the tourism business continues to drag. My sense is they have to probably, for a bigger re-rating on the stock or a larger move, I think they have to figure out a way to monetize this traffic they have on the portal, in terms of either marketing or upsell and cross-sell opportunities. If they can do that, there's a lot of potential there. But with the OFS now, there could be maybe some near-term pressure, but remains a very, very good stock, one of the better stocks in the PSU basket.
In the 2021, I'll stop short of calling it mania, but in some sorts it was. You could call this call that period IRCTC. You can almost use IRCTC as a example to describe what was going on. It was just incredible, right? From a low of some 250, it went up to 1300, recently it's done well. From 500, it's come up to about 700. So we'll see. But good points there. Gurmeet, hi, good morning. So just a couple of points, if you will, on public sector banks and what do you make of it? I put out a piece yesterday basically looking at where all these stocks are, some 6 stocks and where these 6 are compared to their respective historical year forward price to book multiples. 4 were already there and 2 had some distance to go. Now that is one way to do it. You can slice it in other ways, but what's your thought process?
Amazing run, Prashant, taken probably everyone by surprise. I think, but you also have to be careful that the big mistakes happen when the credit growth is high, which is in this case. The last time this kind of credit growth came was post 2009, and when you have this 18-19% growth, it's easier to get carried away. I think it's important to see that how and differentiate the risk underwriting standards in PSU banks. They are prone to accidents and frauds. So I would restrict myself still to maybe SBI and BOB. SBI in particular, I think, while it has consolidated a bit, if you see, I've not seen 17% ROE and 1%, 1.5% ROA for a long, long time. They have almost 3 lakh crores of treasuries maturing next year, which will give them a lot of firepower in terms of, since deposit growth is just 10%. continues to do well across metrics. I mean, 17-18% credit growth, advances growth for a size of SBI is huge. And the mix of the loan is pretty good now, 6 lakh crore kind of a home loan book, right mix of, digital with Yono app coming in. So I think it will be the liability side, in my view, which I said earlier, which will be a differentiating factor going forward, and responsible credit growth. So I would stick with SBI, and maybe Bank of Baroda for now on PSU space, and not get carried away with the recent surge.
Absolutely. Gurmeet, stay with us. You were talking about retail franchises like Bajaj Finance, etc. Another one is IIFL Finance. And, this is the first company on our corporate radar. The stock is up more than 58% in the last 1 year. I mean, this is 12 months, but if you just, it's done more if you kind of take the starting point as December 31st last year, it's up about some 70-75%. The company recently entered into an agreement with Capital Group and has obtained a co-lending commitment for nearly $2 billion. To discuss more on this and how the business because of this will be bolstered, Nirmal Jain is founder and chairman at IIFL Finance. Nirmal, great to have you with us here on the program. Thanks very much. We usually have Nirmal on. We've had Nirmal on to talk about what his view on the market, etc., is, which has been prescient as well. But the business which you've built, Nirmal, it's also been incredible, and the markets, of course, are taking note of on IIFL Finance. Earlier on the wealth side, etc. Could you tell us what this agreement, what this agreement really is from your point of view? What are the terms of this agreement, and what will happen because of this from here on?
No, I think there's a small correction actually. The co-lending is with the banks and with not Capital Group. Capital Group has invested in the company.
Okay.
So the co-lending that we are doing is with multiple PSU banks and private sector banks. Right. Here. We use our branch network, our people, and originate priority sector loans primarily, and also other retail loans. And when under co-lending arrangement, 20% of loan is on our books, 80% is on banks' books, and we service the loan through the entire cycle, including the collection and the top up, and further the customer belongs to us. So customer basically serviced by our branches, and get the full interest margin on our 20%. And on 80%, we agree with the bank certain rate of interest that we need to give to them, and the remaining comes to us. So
Nirmal, so basically you're the conduit in that sense. For 20%, you're the owner of the loan. For the rest of the 80%, you're the conduit, and the customer is facing you. I mean, they borrow this through you.
Yeah, absolutely. So for 80%, we are the bank's partner, like an agent.
Okay.
So we are sourcing it for bank. The loan goes on the bank's balance sheet, and bank basically is as good as like it's co-lend. So both of us share the risk, pari passu with the loan amount.
Okay, all right. Good morning, Mr. Jain. I think co-lending is currently 8% of your book?
No, co-lending, okay, so the loan assets which are sold to banks is almost about 38%.
Okay.
So we do co-lending as well as the direct assignment.
So that's your off-book portfolio, right, Mr. Jain?
Yeah,
the 38% that you're talking about, and that has moved up from around 24%, I think, in the last few years. So where do you see that number headed? And also co-lending is a part of that. So how much will that contribute?
So co-lending, I think, which is, I think is around 8%, might go up to 20% in a year's time. And this entire off-book portfolio, which is about 37-38%, will move towards 45 to 50% maybe in a year and going forward.
Okay. Mr. Jain, good morning. This is Sonia here. Just wanted to talk a little bit about the overall growth, because your retail focus has increased. Now about 94% of your book is from the retail segment. And if you look at the numbers, your consolidated AUM for the entire book is over 55,000 crores, with retail constituting 94%. Can you tell us what kind of growth do you see? On a compounded basis, you've been growing about 15-17% in the last many years. Is that something that you can continue to grow with? And what does the next couple of years look like?
So I think the growth slowed down during COVID period, and our focus is on retail. So the retail segment, we can, we at least, we envisage, or our target should be 25% annual growth for the next 3 years at least. Okay. We see very strong demand, and the branch network that we expanded in the last 2 years should help us to tap the demand. So our targets or our, the guidance would be around 25% growth annually.
Okay.
Okay, all right. Nirmal, give us a couple of other numbers then. Everyone's talking about NIMs likely to come under pressure, but I believe you have ring-fenced yourself even out there, and you believe that you would not like to see big deterioration. I think in the last, in the first half of the year, it was 8.1%. What is the number you're looking at maintaining? And also your, GNPAs were around 2.5%. That is that. Can you maintain it at these levels?
I think, maybe the longer term or medium term, we should look at 6.5 to 7% NIM.
Okay.
And our GNPA should be below 2%. And cost to income ratio should fall because the pace of branch expansion has slowed down, because in the last 2 years, we had a very aggressive expansion of the branch network, and that led to cost to income increase from 35 to 43%. Over the next 2 to 3 years, we should see it coming back to the historical levels. But NIMs, I would say that, we should look at 6.5 to 7% as a sustainable NIM over 3 to 5 years.
Okay, 6.5 to 7%, right? You're also increasing your focus in certain areas like affordable housing, small ticket MSMEs, personal digital lending as well. Some of these pockets are a bit vulnerable. Do you think that there could be some pressure on asset quality as the focus goes up in pockets like this?
So 2/3 of our portfolio is gold loan and home loan, where the collateral is very good. And historically, if you see, then most of the mortgage players as well as gold loan companies would not have had any significant loss through the cycles, because you always can realize the collateral, whether it's a house, property or gold, which doesn't depreciate unlike many other collateral. So I would say that, almost 85% of our book is secured, either against home loan, gold loan, or loan against property. And therefore, at least we don't have much concern on the recovery during the cycles as well.
Housing, absolutely, and gold also, because as you said. But gold is how much? You said gold and housing is 50%, but how much
Gold loan is around 32% of our portfolio, and home loan is about 35%.
So when we speak with pure gold financiers, they say growth there has come off quite a bit because of competition. Nirmal, are you the competition, or are you also facing some slowdown there in gold loans?
No, there's definitely a significantly increased competition by banks as well as many new NBFCs. We have been able to maintain some growth because we expanded our branch network by 40% last 18 months. But if you really see, then the growth is not as much as we would have liked to, or is not commensurate with the growth in the network, primarily because of heightened competition. But I think this is a phase, because in gold loan, what happens is that your operating costs are around 6 to 7% on a fairly mature basis of the loan amount. And therefore, the optical NIMs, at 16 to 18% when you lend, look very high, but your ROAs are similar, if not lower than other businesses. So many a times competition becomes very aggressive, but they don't recover their operating costs fully. And within a quarter, 2 quarters, or sometimes in a year, we see that the 10-line NIMs come back. But at this point in time, you are right that there's a tremendous pressure in the gold loan business of very intense competition.
There is intense competition, but your growth in the gold loan space has been pretty impressive. I mean, it's almost a 40% growth that you've seen compounded in the last 3 years. Do you think that is sustainable, or, because of competition, it would be a tall ask?
So this year, growth has slowed down. Like last quarter, I think we had a 4% quarter-over-quarter growth. So, that probably annualized will be around 15 to 20%. So this year we are feeling the pressure of competition in terms of growth. Otherwise, our expanded network should have delivered more. But I think our growth growth is function of gold prices as well. Because in 2021, when the gold prices went up by almost 40%, every gold loan company grew very well, because your ability to loan against the same quantum of gold is much higher. So I think if gold prices remain stable, then gold loan probably should grow at 15 to 20%.
Good speaking to you, Mr. Jain. As always, wishing you all the best. Thanks so much for joining in and giving us insights into your business. For the time being, though, we'll slip into a short break. On the other side, our technical experts will be with us. Sudarshan Sukhani and Mitesh Thakkar will be joining in.
Okay, welcome back. Let's go straight to our technical gurus to tell us how to expect trade this morning. Sudarshan Sukhani, Mitesh Thakkar joining in. Sudarshan, let me begin with you. We're going to start on the back foot, but what do you do from there?
Yeah, good morning, Sonia. See, chances are that we are going to follow the US markets today. The US markets were subdued finally, and the chances are we'll do the same. We are opening lower, and we are likely to remain choppy. Now, this market is not in a downtrend. So the choppiness is simply a day when you do nothing and let it go by yourself. So the trade is that we wait patiently for the Nifty to find support and go long. I don't think that will work out today, but don't go short. Let the markets stabilize at some certain level, wherever they want, and then we'll consider buying the Nifty again. So for today, avoid the Nifty, avoid the bank Nifty, but be willing to buy the Nifty on a dip.
All right, Mitesh, good morning. What about you?
Good morning, Nigel. I think on the index, we did manage to get past 18,600 and then the follow through took us to 18,700. I think there are multiple pivots on the intraday chart. So I would still wait it out. Opening below 18,600 means that I won't take a long unless until we start recovering and recapture this 18,600 levels. Then only I think we'll explore longs. Even in the bank Nifty, there was some loss of momentum yesterday as the IT sector picked up and the bank Nifty closed very flat when the market was slightly on the positive side. So I think if the bank Nifty starts dipping below 43,980, that's my trading stopper, then I think we'll exit longs there as well.
Okay. How about individual stocks? Sudarshan, what's on your list?
Well, Glenmark is a buy. The stock has been having a decent run. It's in a consolidation and likely to break out. Fortunately, pharma stocks don't get direct relationships with the Nifty quite often, so it may do its own thing. Buy with a stop under 418. Dr. Lal Pathlab is an intraday short. The stock has been in a mini bear market, and that's likely to continue. Sell with a stop above 24.30. Remember, it's intraday. India Mart is another intraday short. Again, a small mini bear market is on into that stock. Sell with a stop above 44.59. And finally, Adani Ports is a buying opportunity. Both the buys that I'm talking about, Adani Ports and the earlier one, Glenmark, they're not necessarily a buy for the day. They're a buy for a positional trade. So Adani is a buy with a stop under 879.
And what about you, Mitesh?
On the stock side, I have more buy calls and one sell calls. Rampur Chini on a mild dip because the market will open slightly gap down, buy around 380 with a stop at 374, targets of 392 here. City Union Bank is a buy with a stop at 196 for targets of 218. And on the sell side is Colgate with a stop at 1590 for targets of 1530. The final buy call is on Gas Authority of India Limited. Disclaimer, we have some call options positions over here, so vested interest. But that's a buy with a stop at 94 for targets of 101.
Right, gentlemen, thanks so much for giving us your picks as well as your call on the index. We'll come back to you all at around 9:10 a.m. today. For the timing, we'll slip into a short break. On the other side, we'll get you pre-market opening. We'll also be joined by Amit Dixit, analyst at ICICI Securities. He'll run us through his view on the metal space.